With market turmoil appearing to have subsided for now, we take a look at what next week has in store for the markets. On the monetary front, we note a relatively quiet week from policymakers, including public holidays as Christian Easter approaches. However, we note the release of Australia's RBA interest rate decision on Tuesday and New Zealand's RBNZ interest rate decision on Wednesday. As for financial releases, we make a start on Monday with Japan's tank and manufacturing and non-manufacturing indexes for Q1, China's Caixin manufacturing PMI, Switzerland's CPI rates, Turkey's CPI rates, Germany's final S&P manufacturing PMI, Canada's manufacturing PMI, and the US S&P and ISM manufacturing PMI, all for the month of March. On Tuesday, we note the release of Canada's trade balance for February. On Wednesday, we note the release of Germany's industrial orders for February, Eurozone's composite PMI, UK services PMI, and the US ISM non-manufacturing PMI, all being for March. On Thursday, we note Australia's trade balance and Germany's industrial output, both for the month of February, followed by UK's Halifax house prices for March, Sweden's GDP for February, the US weekly initial jobless claims figure, and lastly, Canada's employment data for March. Finally, on a US-dominated Friday, we note the US employment report for March, which includes also the NFP figure. The USD is about to end the week in the reds against its counterparts. On a fundamental level, we note the easing of the market's worries for a possible overspilling of the banking crisis in the US. Comments made by St. Louis Fed President Bullard last Friday mentioned that some entities have failed to adapt to the changing financial environment, at least yet, which would imply that besides SVB, there are other commercial banks that may present liquidity issues in the future. Also, we note Fed Board Governor Barr's testimony before US lawmakers that supported Bullard's statement. On a monetary policy level, we note a continuance of the aggressive hawkish rhetoric of the Fed and comments made by Minneapolis Fed President Kashkari that there is still more work to do to combat inflation, implying that more monetary policy tightening is necessary where characteristic. Overall, should policymakers continue to stress the need for more rate hikes, we may see the USD gaining some ground. On a macroeconomic level, we note the slowdown of the final GDP rate for Q4, and we expect the market's attention next week to turn to the release of March's US employment report with its NFP figure. Overall, should the US employment data show a tightness in the US employment market, which would allow the Fed to proceed with more monetary policy tightening, we may see the USD gaining and vice versa. GBP is about to end the week substantially high against the US dollar, the JPY, while remaining relatively stable against the common currency in a sign of a broader strength. On a fundamental note, we note that the UK appears to have borne the least criticism for its banking industry, as the news cycle primarily focuses on the US and the EU. On a monetary level, BOE Governor Bailey's speech on Monday was hawkish in nature and could be perceived as an indication of the intentions of BOE. As such, we could potentially see inflows into the GBP, as a similar rhetoric was echoed by BOE's man, and should the BOE officials continue to display such hawkishness, we may see the pound gaining. On a macroeconomic level, we note UK's final GDP rate for Q4, which accelerated slightly in comparison to the preliminary release, indicating that the UK economy has relatively improved and might be entering a period of growth once again, yet at feeble levels. On the flip side, any further monetary policy tightening may obstruct economic growth. Hence, we intend to monitor closely any key financial releases stemming from the UK. JPY is about to end the week lower than the greenback, the common currency, and the pound, indicating that the JPY has shown a general sign of weakness as market sentiment returns back to normal. On a fundamental level, JPY seems to be suffering some safe haven outflows given the easing of the market's worries, and we expect the dual nature of JPY to continue to play a key role regarding its direction in the coming week. On a monetary policy level, we note that the change in leadership at the BOJ could indicate that new policies may be ushered in, thus upheaving years of ultra-loose monetary policy settings and translating into potential uncertainty surrounding future policy. We note the statement by BOJ's new Deputy Chief Uchida, who on Wednesday indicated a willingness to move away from the central bank's bond yield control policy. And should market expectations for an alteration of the bank's ultra-loose monetary policy intensify, we may see JPY gaining some support. On a macroeconomic level, we note that Tokyo CPI rates slowed down for March, which tends to foreshadow also a slowdown of inflationary pressures in Japan on a more general level for the past month. As for economic activity, we note the improvement of Japan's PMI figure for March on the crucial manufacturing sector, yet also note that the indicator's reading indicated another contraction for the fourth month in a row. The common currency was on the rise against the US dollar, CHF and JPY, yet seems to be neutral against the GBP for the week. On a monetary level, we note Eurozone's easing of inflationary pressures as recorded by the preliminary PMI readings for March, which seems to be also easing the pressure on the ECB to hike rates. It should be noted that the ECB stated in its last interest rate decision that future policy changes will now be more data dependent. Given though that the CPI rates are still above the bank's target, should there be a potentially hawkish rhetoric from ECB officials, we may see the common currency getting some support. Overall, on a macro level, the slight worsening of Eurozone's business climate, and particularly the economic sentiments worsening for March, tends to intensify worries for the Eurozone, as does also the wider contraction of economic activity in Germany's manufacturing sector. On a fundamental level, the continued social upheaval in France and strikes in Germany may slow down growth, and given that the market discounts such developments in advance, may weaken the common currency. Also, we have to note that the recent shakeup of Deutsche Bank last Friday sent shivers down the spine of Euro traders, yet since then, market worries seem to have eased, allowing for calmer thoughts. The situation, though, tends to remain fragile and requires continuous monitoring. AUD seems to have remained relatively unchanged against the US dollar, maybe edging a little bit higher as the week draws to a close. On a monetary level, we note that Treasurer Chalmers seeks bipartisan support for an overhaul of the RBA, including proposals to transfer power from the RBA to a new committee of economic specialists and fewer meetings to discuss interest rate decisions. We highlight RBA's interest rate decision on Tuesday, and the market widely expects the bank to remain on hold. Please note that the bank is expected to stand pat after 10 consecutive rate hikes. Should the bank actually remain on hold as expected, the market's focus is expected to shift towards RBA's forward guidance in Governor Lowe's statement. Should the governor signal that the bank intends to pause its rate hikes, we may see the Aussie weakening. On a macro level, we note that economic activity seems to have contracted across sectors for March, which tends to be worrisome. On a more fundamental level, a possible deterioration of the US-Sino relationships may weaken the Aussie given the close Sino-Australian economic ties. On a macro level, we highlight also the slight drop of China's MBS manufacturing PMI figure, potentially implying fewer exports of raw materials from Australia to China. Overall, given the low number of high-impact financial releases stemming from Australia in the coming week, we expect fundamentals to be in the driver's seat for the Aussie. Also, the CAD seems to show a substantial improvement against the US dollar for the week. It should be noted that Canada's manufacturing and employment data for March are set to be released next week. On a macroeconomic level, we highlight the acceleration of the retail sales growth rate, definitely a plus for the Canadian economy. On the monetary front, following BOC's last interest rate decision to remain on hold, we note BOC's Gravel's statement on Wednesday that the bank anticipates inflation to decrease in the following months, thus solidifying its view to remain on hold, i.e. pausing its rate hiking path. On a more fundamental level, we note that WTI's price seems to have substantially increased for the week in comparison to last week, given the tight oil market in the US, as presented by the weekly drawdowns in US oil inventories, but also the possibility of tight oil supplies from the Iraqi Kurdish area. Should the bullish tendencies for the commodities price be maintained, the support building up could be reflected in the CAD as well, given that Canada is a major oil-producing country. Furthermore, on a fundamental level, we note as a positive development Rocktech Lithium's new first-of-its-kind lithium conversion plant in Germany potentially. As a closing comment, in the event of no groundbreaking news, you may see the market remaining relatively calm, possibly returning back to normality despite the situation with the banking sector still bearing a certain degree of uncertainty. Following the prevention of Deutsche Bank experiencing a bank run, the market seems to have calmed down and the bank crisis rhetoric seems to have eased. In a more general sense, we may see the USD increasing its influence over the FX market as the gravity and frequency of US financial releases tends to increase in the coming week, with the highlight being definitely the US employment report for March next Friday. On the monetary front, we would like to note the upcoming interest rate decision of RBNZ next Wednesday. Currently, in the DOS imply 97.8% probability for the 25 basis point rate hike, which, if realized, could support the Kiwi, especially if it's being accompanied by a hawkish rhetoric. In the equities market, the sentiment seems to have improved, especially in the US, with a positive overspill in Europe as well. Also, the stabilization of US yields may allow gold traders to be more optimistic. The negative correlation of the precious metals price with the USD was relatively visible this week, with minor changes seen in both trading instruments. With the stabilization of the USD, we saw gold remaining also relatively stable as well, as traders await US economic data next week. Nevertheless, the drop below the psychological threshold of $2,000 per ounce at some point during the week could be indicative that the mentality of traders seems to be shifting. Thus, we may see the bears take over the precious if US data comes in stronger than expected, supporting the greenback. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
In today's session, we will look at platinum as a trading instrument and its appeal to investors. The precious metal has posted significant gains the last few years, especially due to rising demand after COVID-19. However, it is often ignored by investors who turn to gold and silver markets due to the higher volume. Platinum is important for the growth of the hydrogen economy, and demand could expand even further, posing plenty of opportunities for platinum buyers. In the meantime, there are possible trading risks to consider, including a strong USD and falling platinum demand. The pandemic has changed many things and unsettled demand and supply in platinum. While jewelers and car makers were not so interested in the metal as in earlier years, COVID-19 has driven money to precious metals, with many investors turning to platinum. At the same time, its supply was also hurt as lockdowns did not allow for its mining. Platinum is mined in South Africa in Marikana, with the first platinum nuggets being discovered back in 1924. Anglo Platinum in South Africa is considered to be the world's largest producer of platinum. 7 million and 8 million ounces of platinum are used each year. Platinum plays an important role in renewable energy, especially in electrolysis and in the fuel cells that use it. The hydrogen economy refers the use of hydrogen as a fuel for heat, hydrogen vehicles, energy storage, and transport of energy. The use of hydrogen promises to reduce fossil fuels and limit global warming. Many countries, including the European Union and China, have pledged to reduce carbon emissions by 2050 to 2060 and are invested in hydrogen power. Renewable hydrogen technology generates gas from water and stores it in fuel cells to be used in homes and vehicles. The wider use of hydrogen technology in the near future will require increased quantities of platinum. The limited supply of platinum, coupled with the possibility of hydrogen technology boosting demand for platinum, provide a bullish outlook for the precious metal for the coming years. Investors would be interested to see what will happen to the precious metal and its role in hydrogen economy, but also whether automakers will return to platinum in the future, as the current prices are a strong incentive. This could also push demand for platinum higher. Thank you for watching.
Alrighty, let's get going. So again, welcome everyone. Thank you all for attending this session. Today we are here with IronFX on a webinar series, the trading strategy session, or trading strategy clinic. So what we do here is that we will be looking for your questions. If you have any questions about your trading strategy, if you'd like to share with me your trading strategy, I'll be happy to give you my views, possibly try and help you tweak it a little bit to maybe get a little more profitable or get it more consistent. So if you have any questions, please feel free to put it into the chat and let me know. All right. With that as well, what I'll be doing is I will be sharing with you how I approach the markets, what I look at, what I think about when I look at the news and the charts before getting into a trade. So I'll be sharing with you my thoughts and possibly some ideas about the markets as we go through the news and the charts. So as usual, before we get any further on, quick disclaimer, information in this webinar should not be considered as investment advice or an investment recommendation, but instead as educational material only. This material is just a personal opinion of the author, myself, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. What it means is that I will be sharing with you, or might be sharing with you, some trade ideas, some possible trade setups that I'm looking at, I could be jumping into. If you do jump into any trades, please make sure you check it, make sure you do your own due diligence, make sure that it fits with your own trading strategy. Okay. And then what I will always suggest is test it out first, maybe on a demo account or on a smaller trade size. Once you gain more confidence, you understand the trade itself, then you could start looking into a possibly larger trade. One other thing is that because I will be looking at quite a number of charts and quite a number of trade ideas, please make sure you check your leverage, check your margin, right? You don't want to be jumping into all the trades, because that will definitely lead you to over trading. And through my experience coaching a lot of retail traders like yourselves, it's not so much a bad trading strategy or one or two bad trades that's going to cause you a lot of problems. It's the over trading that's going to cause the biggest problem. All right. So just bear that in mind. This session is being recorded. I do believe that it will be uploaded onto YouTube. I'm not sure when after, so immediately after or after a short delay, but it is being recorded. I do believe that it will be uploaded onto YouTube. So John just shared here, he does a breakout and a retest. Is my strategy, how can I get 80% accuracy? It's I was just actually helping a guy out with his trading strategy. He sent me his trade history, he sent me all the trades that he's just got into recently, and he had the same question as how does he get his hit rate or his success rate higher? It's not so much about the accuracy. All right, accuracy is important, but it's not so much entirely about the accuracy, because you want to consider as well your risk to reward ratios as well. All right, because if you're looking at for example, a 1:1 risk to reward, then you need your accuracy to be a lot higher. If you're looking at a 1:2 or 1:3, or even at some level 1:4 risk to reward, then your trading accuracy could be a little bit lower. Not saying that we'll just jump into random trades, but your accuracy could be a little bit lower. But understanding that for the trade with a good risk to reward ratio, it's going to be you're not going to have all your trades work out. Even, well, in general with trading, we know all trades are not going to work out, but one bad trade is going to be easily, or multiple bad trades is going to be easily covered by one good risk to reward trade. Okay, so try not to focus too much on just the accuracy alone. 80% is a very high rate to get it to. So it depends on how many trades you get into on average, what kind of risk to reward ratios you have. And then you start considering all that together with the success rate. Okay, John, so if you can, give me a bit more info, I'll give you more viewpoints from that. So another question there is, what do I mean by over trading? In terms of over trading, you want to make sure you want to calculate what's your capital amount, right? No, not calculate, but you want to understand that with your capital amount, what's the maximum trade exposure you should be having or you can have. Okay, so and also the number of trades you can have. So for example, based on a $10,000 account, right? What I would say generally on a $10,000 account, I would say your maximum trade size or your maximum trade exposure would be one standard lot, right? At a maximum, you say is one standard lot. And then if you find yourself entering or having an average exposure of 2 or possibly even 3 trades at a time, then because you have one standard lot, if you have on average about 2 trades at a time, you'd say that you shouldn't be entering at more than 0.5 or 5 minis at a time, because if you had 2 trades, it would be one standard lot. That would be the maximum amount. What I would normally suggest is to go even smaller than that, because you just never know when you might have that itchy finger and want to enter one more trade. So what I do tell a lot of my traders that I'm coaching, for example, if you have a $10,000 account, you could be your maximum trade size would be a one standard lot. I would say, hey, go smaller, right? I would say that even at that point, your maximum trade size should be at 0.5. Then you would have a 0.25 for the first trade, 0.25 for the second trade, and then 0.25 for the third trade. At least at that point, you still wouldn't be reaching your maximum trade exposure. Okay, that would be a very risk adverse approach to adopt, but we want to encourage the thought and the process that trading is for the long term. The trading journey is for the long term. I've seen a lot of people trade maximum size or twice as big as they should be just to try and go for that big returns, right? A lot of people have been talking about 20% returns or 50 to 75% returns in a month or in one trade. That's always possible, but you want to think about consistency rather than just that one trade or that 1 month of good results, right? So I would say, go for that 6% return in a sorry, pardon me. I would say go to the 4, 6, 8% return in a month, but aim to have your drawdown at a minimal, and then aim for that consistency with your trading rather than to try and go for that big trades. Okay, so over trading is understanding how many maximum trades you should have, and then what's your maximum trade exposure or maximum lot size exposure that you should have. Okay, I hope that makes sense to you, John. And then a question from Ruthik. Sorry if I'm mispronouncing your name. Question from Ruthik. What do you think are the 2 best indicators that work together? Okay, in terms of indicators, what I would say very quickly is that there are a lot of indicators out there. Actually, while I have that, I'll bring it up and just show you guys. Take that away. Okay, so I'll just put up a chart just to show you all the list of indicators that you can have. All right, bring up my layout. Where is it? Right, close that out. Okay, so you can have a lot of indicators. If you go into there, you get a whole list of them and even more as well. Um, there's really no best indicator to work, but I like how Ruthik is asking about the two best indicators. So you're not talking about the one best one or the one indicator to have. It's good to have a combination of indicators, and you want to have it as different style or different types of indicators, right? So you want to have an oscillator together with, like, for example, a moving average, or you would use a stochastics together with the Fibonacci. You want to have a combination of indicators just so that it doesn't all give you the same idea. Say, for example, if I used a stochastic and an RSI, right? So we have the stochastics here, we have the RSI here. It's going to give you very similar indication. It's very good, right? Using the same word, but it's going to give you very similar indication. You can see here that if I move this line right across, the stochastics pushing towards upside, the RSI pushing towards upside, it's going to give you very similar indications, and you don't want that. You don't want that same thing because it's just telling you the same thing twice over. What you want to try and do is, for example, to have the stochastics and then also use, either the Bollinger Band or like the Ichimoku cloud in this case. We'll take some of these lines away just to make it a bit easier to see. Okay, so if you even just consider the cloud alone, it would make it a lot easier where you have the stochastics telling you that we could see some upside move. Sorry, my throat is terrible today. And then after that, you see the cloud, or you see price. Take that all away. Right, and then you see price breaking through the cloud or some upwards to the cloud, then you'll be looking for the upward potential. So you use a combination of indicators to give you a good all-rounded view, building that confluence. Now you have a confluence of indicators working together to give you that confidence on your trade. In terms of which are the two best indicators, I'll tell you that, as I said, no real best indicator, but what I use, I'll share with you the setup I have. For me, I have the MACD. All right, and also I have the Bollinger Bands. Right, so I have the MACD just to give me an idea of how, crossover levels, or potential crossover levels to see either the upside or the downside, and then the Bollinger Bands to tell me when it's outside of the band, we could see a retracement back in again. So I use a combination like that. I do look at support and resistance levels as well. So I have my approach. I look at the news first. Then after that, I look at the trend, support, resistance, and then the indicators. So just based on that, you can see that I actually place very little importance on the indicators. The way I trade, more on the news, the trend, and the support resistance levels, right? So more momentum trading with breakout. I think someone mentioned about breakouts there, and then with the trend following as well. All right, so I hope I answered your question there, Ruthik. Hey, Mohal. I'm learning trading and getting used to the jargon and all. There's a lot to learn, and I'm afraid of investing any real money. What advice would you give to a newbie to trading? There's a lot bombarding info on Forex, and I'm afraid of going into wrong directions via YouTube videos and schemes. Very good question there. I would say that good thing is that you're reading a lot, you're getting used to it, you're learning a lot. I would say that, test it out, right? Test it out. You can still check out, there are some good YouTube videos just to give you the information, test it out. There's no harm in using a demo account just to test it out and to build that strategy, to build the confidence, and to get familiar with trading to start off with. All right. So what I usually suggest to newbies is that, read it up, read stuff, learn, but very quickly as you learn, apply it onto a demo account, right? Apply it onto a demo account, test it out, see how it works. One thing you don't want to do is to spend so much time reading but not testing it out. Then you end up, having too much information, like what you're probably facing, and then after that, still not knowing what to do or where to get started on. Okay, so read it, test it on a demo account, enter demo trades. Then after you build that confidence or some confidence, you start small. You get into a small trading account and then trade at a small lot size, at a minimum lot size, just so that you see how you behave when there's real money involved, when there is a real trade and real money involved, potential profits and losses. At that point, what you want to consider, or what you don't want to be considering, is how much money you're making. You want to stick to the process. You stick to the process, test out the process, test out the confidence. Then you slowly progress along to build your trading activity and your trading profile. Okay. Hope that answers your question there, Mohal. All right. Gary asked, could you show us how you use the cloud, the Ichimoku cloud? I will get to that shortly. And where would you place stop loss and take profit? Okay, that's easy. I'll get to that. Ruthik asks, where do we get these news about Forex from? Any particular place where we get news that help us with trades? Okay, that one's easy, so I'll answer that straight away. For me, on my screen, whenever I'm sitting in front of the computer, whenever I'm trading, first, there are two things that I will have open. I'll have my MT4 open, and also I have Forex Factory open. Okay, so I'll share with you guys the link here. Right, so Forex Factory is where I head towards to get all my news. It's fantastic thing is that it's free to join. Is you don't have to pay for anything. You don't have to pay for the news. It gives you the exact timing of the news release, which currency pair it affects, what news it is, the importance level, the previous data, the forecasted, and the actual data as it gets released. So very good site to use to get your information regarding fundamental news, regarding the news on the Forex markets. All right. Fantastic. I see a thumbs flying up. So good stuff. Okay, so to Gary's question about the cloud, let me just bring that back up. I'll clear out this once so it's not so messy. Okay, so see, the simplest or the most straightforward way I would do about use the cloud, I'll clear out some of these lines because there's a bit too much information there. The most straightforward way you can approach this is that you can see the clouds. Sorry, I'm trying to find a bit of a mix. Okay. You can see the red cloud there or the pinkish cloud there. It provides that indication, red or pinkish, for that downside move. And also it acts as a bit of a resistance level, right? Acts as a bit of a resistance level. So you can see that as price goes up, showing you further, still trading below the cloud, you're still looking at further downside with the cloud being reddish. You still say that it's trading below the cloud. So I'm still looking for some downside move with it being red. Looking at it on the H1 time frame, you can see that this one, for example, here, it's broke through the cloud. All right, it broke through the cloud. Despite it being red, we say that it's traded above the cloud. It's traded above the cloud. Now, instead of it being a resistance level, it's forming as a support level. All right, it's forming as a support level. You can see it came down, came very close to support, bounced back up again, came down very close to support, and then started being green. So now we're looking for upward moves as price trades out of that cloud. When it's in the cloud, whether it's red or green, we'd say that price is in the cloud. The direction of the move will be a little bit more varied, right? It'll be a bit more varied or choppy. So you want to wait for price to either break towards the downside or break up above the cloud before you start looking for that potential trade. Okay, hope I answered your question there. Short and sharp there for you, Gary. And then in terms of where would I place my stop loss and take profit, let's look at not the dollar index, but the Aussie dollar here. Okay. The way I would look at my stop loss and take profits, I would say that I always have my support and resistance levels done up first. Okay, so resistance level because it's tested, came down, support level because it's tested and bounced back up. So the easiest way to think about it is that your stop loss should be beyond. Okay, so your stop loss should be beyond the resistance. Let me put this as a resistance level and this one as a support level. Okay, so your stop loss should always be beyond the resistance. Okay, or beyond the support level. Naturally, if you're looking to sell it down, say for example at this point, your stop loss will be beyond the resistance, and then your take profit will be before the support. So your take profit will be before the support here. Or even before the resistance level here. This is if you were looking to buy it up. So buying, take profit. This will be your selling, take profit. Okay, so as an example, if we're looking at this point here, anticipating that price could trade lower, we'd say that if we're looking to sell at this point, stop loss will be up here above the resistance level. Could be about 65 pips, 70 pips. Take profit will be before the support level at about this point here, about 160 pips towards the downside. You'll be looking at a 1:2.4 risk reward ratio for that selling opportunity. Okay, that also comes to the point where if you were looking to buy this towards the upside, then I would say that take profit, if you're looking to buy here, would be before that resistance level. And if you're looking at this, your stop loss wouldn't be there. Your stop loss would be near that interim support level. Zoom in a little bit for you. You can see that this is a bit of a support level here. Right, so I would say that this is a bit of a interim support level there. So I'd say if I'm buying there, my take profit will be before the resistance, and then my stop loss will be just below the interim support level. Okay, so quite straightforward. Remember, stop loss beyond resistance or support level, take profit before resistance or support level. Answer your question there, Gary. Okay, Chimponda, would you advise someone to trade in a ranging market? I have a working strategy, but sometimes I like patience to wait. How do you master psychology? I want more emphasis on psychology. All right. It depends. It depends in terms of the ranging market. It depends on your trading strategy. Okay. and also what kind of range. If we're talking about a range like that, let me just draw that out. Right, if we're talking about a range like that, then I wouldn't even be looking to trade that. Okay, but if we're talking about a range like that between here and here, right, you can see it trading down and then after that trading back up again. That's a wide range. That's a wide enough range. Then I would say I would go for that wide range as well. Okay, how to approach a ranging market? I would say that you'd be looking for, the safest way would be to look for the pre-existing trend and then trade that range based on the trend. What I mean by that is, if you look at the Aussie dollar here, it's been pushing towards the upside, right? It's been pushing up ever since October last year, and it's been trading higher. So I wouldn't be looking to sell it down. I would sit out. I know that it's a missed opportunity as it trades down, right? I'll sit out, but I'll be looking for buying opportunities towards the upside. I'll be looking to trade it towards the upside. So that way I'm still following the trend while in a ranging market. Okay, Chimponda, I hope that answers your question about ranging markets. And in terms of patience to wait and mastering psychology, I think one good approach that I've actually advised a lot of people to do is to have a bit of a punch card system, right? What's a punch card system? Is to actually have a piece of paper, and you limit yourself. You limit yourself every day to a maximum of, for example, 3 trades, right? Have a number of trades. It doesn't have to be 3. It can be any amount, not too big. Definitely less than 10. Okay. Maybe less than 5. So anywhere from 2 to 5 trades, and limit yourself to those number of trades. So that way, before you enter a trade, you'd have to really consider, is this worth one of your 5 trades for the day? Is this worth one of your 5 trades for the day? That way you actually you build that patience to wait to really look for that one trade that you would have more confidence, you have more confluence before you jump into the trade. Okay, so I find that selection, being more selective of your trade, does help with building that patience. And in terms of mastering psychology, there is really no straightforward way to doing it. It's all about building that confidence, right? Very often, a lot of people have mentioned about, trading with no emotions. I don't believe that anyone's going to be able to trade with no emotions. It's about trading with less emotions, understanding the process, keeping to the process. So, don't try and approach the markets with 0 emotions. It's impossible, almost impossible to do that. I would say that you want to build that confidence and then trade based on the process. And also one more point is that if you feel that you are stressing and worrying over a trade too much, most often the time you're possibly trading a little bit too big, right? You're possibly trading at a size which is a little bit too big. So something you want to check up on. Okay. Fantastic. Thanks for that, Gary and Chimponda. Okay. I love the questions, guys. Just keep it coming. Hey, Ruben, how you doing? You begin at, I just shared the process on how to get started, so I hope you caught that as well. Bollinger Bands and Fibonacci retracements, I can do that. How do you determine a strong support and resistance levels and what time frame? Okay, so I'll share with you how I approach the markets, and then we'll touch on the other parts. I'll bring up one more clean chart here. Okay, so how I actually approach the markets. First off, I would always check the news, right? I'll look at Forex Factory, check the news, see what has moved the markets recently. If there is a big news event, great. For example, tomorrow we do have a lot of non-farm payroll numbers. US employment numbers going to be possibly high volatility event. So I'll be very careful about entering a trade before the news, 9:30 GMT plus 8. I'll check the news first and then I'll look into the charts. In terms of time frame that John was asking about, my support and resistance levels, I do it on the H4 time frame. All right, I do my support and resistance levels on the H4. So for example, in this case, on the Kiwi dollar H4, I would have a support level at this 0.6242 level. Someone asked a question about, can't remember where I saw that question. Okay, but you don't want to consider support level as one line. You want to consider the support level as much as 0.6228 all the way to 0.6257. I would consider this whole area as my support level, support area. And because I consider this whole thing as my support, I'll move this to right in the middle, and then I'll have that as my support level, right? But I still would consider it as a whole area. And if we zoomed right across, you can see how price has reacted very nicely to that area as well. Okay, so first off, I'll do my support levels. I'll do my resistance levels here. And then maybe a next one up there as well. Okay, so I do my analysis on the H4 time frame in terms of support and resistance levels. I'll be looking for a trade on the H4 time frame first. If in this case, let's say, I'm right here and I can't find a trade on the H4 because price is right in the middle of the support and the resistance level, then I would go into the H1 time frame. Then I'll be looking, in this case, no trade, but I'll be looking for a trade on the H1. So I'll do H4 first, then down to H1. If I were, sitting there watching the charts closely, then I might even consider going into the M15, looking for potential breakouts of short-term consolidation areas. Okay. For most retail traders, or for all retail traders, I would say that I wouldn't go anywhere lower than the M15. For me, I look at M1 or M5 only when there's a big news event. All right. Okay. So answer your question there on support, resistance, and time frame. So when we have that, with that, then looking at Bollinger Bands, the way I use Bollinger Bands is only to tell me when it's too late to get into a trade or when it's time to get out of a trade. What I mean by that is you can see that, let's say for in this case, price breaking through that support level, you'll be anticipating to buy. What I've noticed is that when price breaks out of the Bollinger Band, right? When price breaks out of the Bollinger Band, it tends to retrace back down. Right, it tends to retrace back down. You can see several other situations here. As it breaks out, it retraces back down again. Not always, this is possibly a news event that has got strong momentum to push price towards the upside, but once it stays out and hits a resistance level, that's where we get a confluence, and then you see it come back down again. Right, you can see again, very nice one here. Price breaks out of the Bollinger Band. Next moment, it retraces back in. So it tells me when it's too late. Most of the time, a lot of traders would see a big move like that, and then you click sell right there. Once you click sell there, it retraces back up. You hit a stop loss or be in a losing position. This tells me it's too late to get into a trade. I'll wait it out until it hits and turns from maybe even the moving average lying there before selling it back down again. Okay, so That's the Bollinger Bands. It works on all time frames. You can use it, M15, even on H1 time frame. You can see that it breaks out, bounces back in. In this case, this prevents, or this saves you from a potential fake break, right? As price breaks out of a Bollinger Band, you anticipate that it's going to trace back in. So I will wait for it to come back in before looking for a buying opportunity. In this case, a pin bar formed. We know that it's going to trade lower again. Okay, so again, another save as it breaks out of Bollinger Band before coming back in. This same thing here, broke out. Next moment, it traces back in towards the Bollinger before trading lower again, sits across before turning back up. All right. So that's quite straightforward there on the Bollinger Band. The next one about Fibonacci, you can actually be looking at it here. Oops, nope, take that away. So Fibonacci, you would go from left to right, from the lowest point to the highest point, and then you apply the Fibonacci's. You can see it acts a bit as a support, as a bit of a support and resistance level. In this case, zooming in a little bit, you can see that from this point up, right, we've drawn this towards the upside here. Okay, so it shows you that as it comes down, you can see that price retraced from the top downwards, and it's bounced 23.6 level. It hit and bounced. Once it broke that level, 38.2 again provided some level of support. 50%, very strong support level here, bounced off, and then it still traded within this range, now bouncing back up again. So the key level here is 61.8. It's come very close, but it hasn't tested that point. Okay, so quite straightforward there on the Fibonacci. I would say pay attention to those three levels in particular: 38.2, 50%, and 61.8. Okay. So far, so good, guys. If it makes sense to you all, let me know. What's your go-to trending strategy and what indicators you use? I just shared that with you, Gary. Trending scenarios, so I look for trend following strategies or trend following trades. My indicators, MACD and the Bollinger Band. All right, I'm looking. No worries, Moha. Can you explain what support and resistance level is and what it does in the charts? Okay, let's bring up another chart here. Clear it out a little bit and look at H4 time frame. Okay, so what is support and resistance levels? It's really identifying the points, right? The turning points. So I would classify it as turning points where you see price come down, hit and reverse, hit and reverse, right? So it says that in this point, this level there is a good support level, support being a floor, and then a resistance level being at about this point there, or even, at that point there being the resistance level, resistance being the roof. So it provides a bit of a, not fixed, but a bit of a constraint or boundary to help you identify potential levels that price could move towards. What we tend to find is that once we have identified these levels, price tends to, only if it breaks out of this strongly, closing above this level, then we'll see it climb to the next level. So you can identify this turning point here. So if we did draw a line right across, you can see that as we identify there, we have turning points right at this point, bit of a turning point here, and then a bit of a turning point here as well. So if price does break above this resistance level, we could see it climb up towards the next resistance level. So it goes from roof to roof, or from roof to floor and floor to floor. All right, fantastic, good stuff. How many pairs would you advise someone to focus on, or in short, how many asset classes would you ever recommend a retail trader to trade? I would say that you should be looking at about 4 to 6 pairs, currency pairs at a time, right? So for myself, I look at 8 to 10, right? I have a big screen. I have all 8 pairs open up. So I'm monitoring all 8 pairs at a time, but I do know that retail traders don't have all that time to look at all those pairs, right? And also when you look at that many pairs, you need to read all the news and understand all of it together. So I'll say, start off with 2, right? Find 2 currency pairs. And it shouldn't be the same or similar ones, right? So it shouldn't be Aussie dollar and Kiwi dollar. It shouldn't be Euro dollar and pound dollar. Kind of think of it as maybe an Aussie dollar and a Euro dollar, or a Kiwi dollar and a pound dollar. So you get a good mix of market open timings. And then once you get familiar with those pairs, you can add 1 or 2 more after that. So, try and have about 4. I think that's a reasonable amount. Fits on the screen nicely as well. Then you can focus on that 4 to try and take advantage of the moves. Okay. How do you maintain a healthy trading psychology after losing, let's say, more than 2 consecutive trades? Very straightforward. The first thing to do, stop trading, right? If you hit 2 consecutive trades, straight away, turn off MT4, turn off everything, stop trading, go do something non-trading related. Go clear your mind, because if you sit there and go, I've just hit 2 stop losses, right now I need to chase it back, I need to make it back, most likely you're going to hit the 3rd stop loss, right? You're going to be rushing to trade, you're going to be guessing and trying to revenge trade it. So first thing, stop trading right away. And then after that, you can always, reach out, test it, back test your strategy again, right? So after you've taken a break, back test your strategy again, just so that you understand it, have that process tied down and understood, then look back into it and start off and just have the understanding to start off fresh, right? Forget about the 2 trades. Start off again with the same process, going, okay, now it's almost clean slate, brand new, what to do again. I hope that helps. I hope that helps you, promise. Okay, so walk away, take a break, then review the strategy and the process. And then after that, when you start trading, forget about what happened before, start off as if it's a brand new slate. John asks, what trading sessions do you recommend with high volatility? Well, definitely the US, definitely the crossover period between London and the US session. So in terms of GMT plus 8, I would say is 8 to 9 p.m. GMT plus 8. So that's when US is open. Show it to you here. So you see that a lot of news happens at about 9 to 10 o'clock. So 8, 9, 10 o'clock, GMT plus 8 would be the best high volatility, high liquidity periods to be trading. You got to convert that to your own time zone, but that's where we have US markets being opened, and we can see that liquidity being increased. Okay, so you can also, if you use Forex Factory, you can scroll down and you can actually check out the session timing. So you can see right now we are having London being opened, US not opened yet. So we come to 9 p.m. GMT plus 8, we'll have the crossover between London and the US. That's when we're going to see volatility and liquidity being higher. Any advice on currency pairs to start off with? My own currency is fairly weak in money already. I would say that currency pairs to start with. What's the time zone in? Sorry, I'm just going to check this. Current time in South Africa. So it's 12:47 p.m. I would say that the I would say that the pound dollar would be a good one to be looking at, because you notice if you start trading onto this or start monitoring this, you might be looking at better liquidity on the pound dollar, as within your reasonable time frame, right? So I wouldn't say I wouldn't recommend the Aussie dollar or the Kiwi dollar, because that would be really early in the morning for you guys. Then you wouldn't want to be trading during that time as well. So pound dollar, euro dollar, pound dollar, maybe even the US CAD, if you're looking to trade later into the day, that'd be a good pairs to start off with. All right there, Mahal. Good stuff. Thank you all for the questions. I hope you have found it good information, useful and good information for you guys. Any other questions? How many trades do you think are more than enough for one day? Okay, so very good question. Personally, for me, I average about 2 to 3 trades a day. My average, and I've been trading for many years now. It's about 2 to 3 trades a day. But that said, remember, it's an average, so it could be days where I have 0 trades. I have no trade at all. Market's not moving, or I just can't seem to make sense of what's happening in the market, so I wouldn't enter a trade. But there are days where we would have a lot of trades just because it's a high volatility news event, right? And markets are trending strongly in a certain direction. Then I would have more trading opportunities. I'll be entering into more trades. So what I find is that on average, about 2 to 3 trades would be fair. All right. You're most welcome there, Mohal. Any further questions? Time has really flown. I've been enjoying the session. Time has really flown. So are DBBs similar to BBs? I'm not sure what DBBs are. I'm not sure what DBBs are. So you want to elaborate on that? Okay, double Bollinger Bands. Okay, so how I have my Bollinger Bands, let me just clear it out. I have my Bollinger Bands like that. One other thing I've done with Bollinger Bands is, I'm not sure if it's the same one that you're talking about, is that I have the 2 standard deviation and also I have the 1 standard deviation Bollinger Bands. Is that the double ones that you're talking about? So why I have 2, the 1 and 2 standard deviations is because what I tend to notice is that if price trades, possibly not so much here. Let me find this. Okay, there you go. So if price trades within, if price trades within the 1 and 2 standard deviation within the Bollinger Bands, it becomes a bit of a trending scenario. So that's the only reason why I would have the 1 and 2 standard deviation on my Bollinger Bands, just to identify that trending scenario in terms of Bollinger Bands. But a lot of people have said that it does make it a little bit messy in terms of the charts. So, you could even just deal with one single, the 2 standard deviation Bollinger Bands. Yeah, it does. And when you have 8 charts open, imagine looking at it like, imagine looking at it like that, with double Bollinger Bands all over, it's just going to be super messy and almost impossible to pay attention to. Okay. I take profit quickly and delay to close my losses. What do I do? What time frame do you do it on, John? One way you could try is going to make you go slightly crazy, but one way you could try is to enter a trade and walk away. Have your stop loss set, have your take profit set, and walk away. Go do something else. Come back in an hour, or in 15 minutes, or an hour's time, check it, and then if it's hit take profit or stop loss, great. If it's still sitting in the middle, reevaluate. Is there a reason why you want to close out the trade? Find the reason why you want to close the trade. If there is, go for it. If not, walk away again, come back again. All right. I hope that helps. I do that as well. I enter a trade and I go work on something else. I don't pay attention to the charts, and then I'll reevaluate once in a while. I have a community of over 10,000 users. I want to positive because information I have gotten is true. What risk percentage would you recommend on a $500 account and reward? Risk, in terms of risk, maximum risk per trade should be at 2%. Maximum risk per trade should be at about 2%. What I would say is that just be extra careful about that number, because if you have one trade open, it can be 2%. But if you have two trades open, then your maximum risk per trade should be 1%, right? Because your maximum exposure should be 2%, right? Because the common saying is 2% per trade, but then you see people entering multiple trades, and then it's all 2% over and over again. That's going to be super dangerous. I would say is that your maximum exposure should be 2%. Always struggle to know when to let profits run and exit. I'll answer that question already, Gary. Okay. Chimpona newbies participate. Great. Good stuff. All right. A tour, I'm pretty sure it's recorded. Reach out to the guys at IronFX. I'm pretty sure they can direct you to where to get a copy of this session. I'm glad you guys are all finding this useful. We're heading towards the end of the session, so let me know if you have any last questions. Any final questions? Just remember that we do have US non-farm payrolls tomorrow, so just be extra careful on that. Any news strategy? I think you mean news trading strategies. I would say that most retail traders should stay away from news trading strategies for now, because what traders tend to do is try and rush into a trade when you have a news release. That's possibly going to cause you more heartache and more problems as you try to rush into that. So just be extra careful there. What you guys can do, I would suggest, is that you can reach out to me if you want to find out more. If you want to find out more, you can reach out to me here. You can jump onto TradingView. Reach out to me there, drop me a message. If you have any questions, any further questions, I'll be happy to help you with that as well. I do some analysis about, where prices are heading, looking at fundamentals, how to trade the news, how to, a bit of a review of what happened last year. So it's all there, giving you analysis, trade ideas, psychology, and all that. What do you think about the market for the next few weeks or months as recession is inevitable and heading towards the market? That's a good last question, but that's a big last question. I think that recession is inevitable and it's possibly slightly priced in already. So I think it is going to be a good market for traders. Volatility is going to be high, a lot of opportunities to be had. I would approach the markets with a possibly shorter term view on trades, right? So whatever trades I get into within the day, intraday trades, or within the next couple of days, I'll close it out, just because it has been very choppy price action. So I wouldn't be holding on to trades for too long, right? So an example here, you can see on the Aussie dollar, you can see that just get that out. Okay, you can see that just on Tuesday, so 2-3 days ago, it shot straight down towards that 6697 or 67 level, and then almost immediately it bounced straight up towards 6880, right? So very high volatility situations or choppy price actions on the Aussie dollar, and actually right across the board. So I would say, short-term trades. If, for example, you look to sell and you thought that it was going to go all the way down, you'll be caught out as it bounces back up again. So short-term trade downwards and then back up again, or look for that trending scenario. Okay, Ruthik. With that said, I hope you guys have enjoyed the session. Hope you found it very good and informative. If you have, please let me know. I do appreciate the feedback. And do remember, we have news ahead. We have possibly recession ahead. Choppy and volatile price action coming into the markets. Please trade well, trade safe, and I look forward to seeing you at the next webinar again. With that said, take care now, and I'll end the session. You're most welcome, everyone. Thanks, Gary. Thanks, John. The link is there, Ruthik. You can reach out to me at this point. Drop me a message, and I'll be happy to have a chat. Take care now. Bye-bye.